Hi, everyone, and thanks for attending today's webinar on Is Our Empire Crumbling? We really have a long-term focus here at Fountainhead, just because we believe our clients have a long-term focus as well. After all, investments are for retirement or potentially even the next generation. And so all of our deep analysis around explorations are really multi-year. And today, the question of is our empire crumbling is not, will something occur tomorrow or the next day, but what is the state of the nation over the next few years? And in that context, what is the state of the globe, right? Over the last few years, we've really China's been popping up in our attention a little bit more, and in a chart that's about to pop up, you could see that China is really making a lot of headway in terms of competing with the US from a relative standpoint. So this here is a chart that comes from a forthcoming book by Ray Dalio called The Changing World Order. Part of that book has been published on LinkedIn. I think it was a fascinating read, and I recommend it to everyone on the call. This chart in particular shows the relative standing of great empires. It's really worth looking at the blue line, which is the United States from 1750 up to its apex shortly after World War II, where we controlled 80% of the world's gold supply and basically dominated the world, to today, where you could see it's a line that is declining. And then the red line is that of China. And simply inferring from this chart, you could say, okay, it's a matter of years before China surpasses America in relative standing. An article that caught my attention years ago, and I still remember it must have been 20 years ago, was one on obesity trends in America. And I remember the article, I think at the time, maybe there was an obesity of around 20% in America at that time. And based on what had occurred the few years prior, the author of the article had decided that everyone was going to be obese within 10 or 20 years, right? And that's just following a trend line. So you look at that red line, and it's very obvious that from just looking and inferring from that line, China will be the biggest and best empire ever, and everybody else will recede. But we all know that's not true. We all know it's way more complicated than that, and that's the reason we decided to write about it. Very, very high level. When you think about cracks in the US, declining education, increased partisanship and wealth gaps, high debt levels are issues, but then there's also some huge strengths. And some of those we kind of never lose, like incredible geography and natural resources. Those are hard to lose unless someone finds some technology to move the oceans around. We're self-sufficient as a country, and we have the best natural defenses in the world. And then innovation. We've been a leader of in innovation for basically forever, and that's not something we believe will change. So some of those are some of the positives. On China, right? They obviously have faster growth than us over the last few years, and they have a huge population, but it's countered with an authoritarian government, bad expected demographics, not as good a geography as we have, lack of financial transparency, and perhaps issues with innovation. So today we're honored to have with us James Upton, who's going to assist in talking through this topic. James is the Chief Strategic Officer and a Senior Portfolio Specialist for the Global Emerging Markets Equity Team at Morgan Stanley. He's going to provide a brief presentation on empires at a crossroads and its effects on emerging markets. And then we'll have a conversation. During the conversation, if anybody has a question within the audience, please feel free to send in a question. There is a question tab at the bottom of your Zoom. We'd love to hear, and get your thoughts integrated within the conversation. So again, honored to have James Upton. And James, I'm going to turn it over to you to take everybody through a little presentation.
Great, thanks, Joe. And again, thanks for the invitation, and good afternoon, everybody. If we could look at slide 2 of the presentation, and I appreciate a lot of the points Joe has made, and in our discussion in preparation for this webinar, we agree on a lot of views, and I have to say that as a team, our emerging markets team conducts a great deal of original research, and many of these broad topics are covered in my colleague Ruchir Sharma's book, The Rise and Fall of Nations, which I'd also recommend adding to your reading list because it really kind of captures a lot of the thoughts we have on why countries grow and why other countries decline, which is at the thesis of what we're talking about today when we kind of compare the United States and China. So on slide 2, I think one of the broad points to make is that basically from World War II up until the global financial crisis around 2008, the world enjoyed extraordinarily robust growth. And it was a period where the assumption was, there would just always be improving growth. All countries were expanding. Of course, the US had the big advantage for most of those decades for all the obvious reasons. After World War II, we ravaged our biggest competitors with bombing, and then we had the manufacturing edge. But the other kind of big point about what happened after 2008, most of us, I'm sure, on this call today, were working during the global financial crisis, and we remember how severe it was. But some of the trends that have contributed to growth slowing down since then include what we call the 4Ds. And by the 4Ds, we mean, I'll touch on each of them, and the next slide shows the first one, which is depopulation. Joe started to talk about demographic issues. This is broadly the category of depopulation and demographics, which is, we all know from our basic economics why a country has economic growth. And that's either because there are babies being born or there are plentiful immigrants to do the work. And that was all part of the boom, the post-war boom that really went up until the early 90s. There were, the baby boom that we all know so well about was contributing plenty of labor force participation and abundant labor. This all started to turn, though, as we know, after the baby boom has fallen off. There are fewer people coming into the working age population. So these are aggregate numbers, by the way, speaking about the globe as a whole. What had been the baby boom is obviously turned around for obvious reasons we're all familiar with. Educated women are joining the working force, not only in the developed countries, but also in emerging countries. And so that was one of the biggest reasons that growth was already slowing down before the global financial crisis, which is fewer babies being born in the world. On the next slide, the other D among the 4Ds contributing to slowing growth, and I must say, these are all factors well before COVID. And I think COVID, as we'll get into, really just kind of accelerated these 4D trends. But the second D is declining productivity. And productivity was going down even before the global financial crisis. It maybe, was kind of leveling off during the 2000s when the world was growing pretty comfortably. But it was already starting to fall off. And part of the thinking behind this are countless books one can read on why productivity is declining. And one would think that with the advent of technology that we would be becoming more productive. But part of the theory is this is tied in with easy monetary policy because, the low interest rates that the world has now had for many, many years in the developed, but also followed in the emerging world means that there are more zombie companies, meaning companies that would otherwise fail in a more competitive environment, but because of cheap and easy access to credit, they just keep muddling along. And this is where one could argue that we almost are in a phase where we don't want anyone to fail. Anyone who knows their history and knows Japan's market knows that was a burden for Japan starting at about 1989, 1990, and Japan has suffered from that at some level, not enough, they've sort of supported companies rather than letting them fail. And then debt. What I think is troubling, next slide, is, we all know that debt was the big contributor to the global financial crisis in 2008. And debt levels globally now, when you add them all up, are even higher now than they were before the global financial crisis, which should be troubling to a lot of people. Now, again, as I said, these are aggregate numbers speaking for the world as a whole, developed and emerging alike, but there are a lot of distinctions within countries, and some countries are more indebted than others. And I think Joe and I will talk about that in our conversation about why it is important to have less debt and why it does make you more competitive when you have less debt. And a lot of the emerging countries are actually featuring that. They don't have a lot of debt. Now, the other fourth D that's been contributing to the slowdown is de-globalization. I don't need to tell anyone on the call that this has been a trend that really was arguably starting around the time of the global financial crisis, where we just started having more countries take a more hostile attitude toward globalization for all the obvious reasons. After the decimating recession we had after the global financial crisis, people started to say, what was behind this? And what had been a globalization phase that had really lasted for, a good 3-4 decades, started to turn sour after the global financial crisis, because countries, companies, citizens, whether it was the British voting for Brexit, whether it was Americans voting for Donald Trump in 2016, there was a greater expression of sort of questioning or resistance to globalization and saying, how has this affected our labor force? Maybe this isn't such a good thing. And so de-globalization, while it maybe manifested itself most in a pronounced way during the Trump administration, was actually already in the works going back to 2008. And this is a trend that we don't think is going away. Even the incoming Biden administration, or incoming now the Biden administration, is obviously going back to multilateralism, going back to alliances with our former allies, engaging in trade again. However, it is a bipartisan issue to challenge China, in our view, and that's going to be popular with both parties into the future. So deglobalization, we think, is a trend that began a good 10, 12 years ago, and is still going to be around even with the change in the new administration. On the next slide, I don't need to tell anyone on this call, and hopefully you've all participated in it, but the US was the place to be the last decade. No question about it. This is just looking at stock market returns over the last decade, and the US just blew away all other segments, including China. So with all the focus on China in the last few years, with its big Tencent, Alibabas, et cetera, it still was dwarfed by how well one did in US equities. Better than India, better than China, and obviously better than Japan and Europe, or emerging markets as a whole. But we've done some work on that, and we actually found that after a decade of outperformance, those things tend to reverse, and that goes back to history. It's rare for one big idea or theme to really kind of outperform 2 decades in a row. We do think the U.S. It's strong language to say the empire is crumbling. 10, 12 years ago, there was also a lot of negative sentiment written about the United States by pundits. And of course, the US ended up having this great decade. Partly, people were a little early in calling for the end of the empire 10, 12 years ago. And what was ironic was that because emerging markets had had such a great decade from 2000 to 2010, once again, investors projected forward and assumed that emerging markets would have another great decade. And they kind of lost the fact that the US was the one out of favor in 2009, 2010. Emerging markets was arguably overhyped. Today, we think the reverse is true. Emerging markets has been neglected. They have not had the performance of the US. And we think a lot of factors, whether it's the weaker dollar, whether it's valuations, whether it's improving growth in the emerging markets, all kind of favor emerging markets. And Joe and I will talk about that a little bit more. Now, when it comes to China, on the next slide, I think it's very important to put it in context. Obviously, it's a huge market, huge country. We could talk for 5 hours just about China alone, but some broad points I want to make is that I think, and poor Charles Dickens, I hope his heirs are still collecting royalties for everybody's overuse of A Tale of Two Cities, but one can't help but say A Tale of Two Markets when it comes to China, because it really is two very distinct things happening in China. The old China, which is mostly state-owned enterprises, don't forget that there's still a lot of that in China. The state has the majority stake those are largely indebted companies. Those are in the old, quote unquote, old industries, energy, materials, utilities, telecom, et cetera, but also real estate. The government has a big stake in a lot of the state-owned enterprises related to real estate, but this is a very different from what has gotten all the attention of investors the last several, maybe 3-4 years, which is in the tech space, healthcare, consumer education, media, these sort of companies. These are privately run, meaning publicly traded, yes, but not influenced or controlled by the state. And that's where really all the growth has been and where all the equity returns that everybody gets excited about have been. But it is important to keep in mind that roughly half of the China A share market, which is the domestic share market, about half of that is state-owned enterprises, and the other half is this new part. With the broad MSCI EM index, about 63% today, or last year when we did this a couple months ago, 63% was new China, about 37% old China. So just important to keep in mind if you ever are considering, buying the index, which we argue against doing, you would be buying a lot of passive state-owned enterprise China, which we would say is a bad idea. Looking at the next slide, just a reminder that, again, when you look at corporate debt, very little of it is in the, very little of the corporate debt is state-owned. The non-state-owned share of the economy for corporate debt is on the very low end. So very little in the private sector, very little of the debt accumulation. Most of the bad debt that you read about in China is related to the state-owned enterprises. Next slide, and Joe and I will talk more about this, but the dollar obviously is very important as a reflection of, the empire. We've done a lot of work on our team, and it's interesting. The main currency that is the preferred currency of reserve historically has lasted for about 100 years. The dollar has been the predominant reserve currency worldwide for about 100 years. Before that, obviously, it was the British pound and each of the other empires that Joe's chart referred to, Spain, France, the Dutch, they all had their share of having the predominant world currency that things, traded goods settled in. So the dollar has had not only dominance for 100 years, but within that 100 years, there's obviously been long periods of strong performance and then underperformance. And those tend to last 5, 7, 9 years or so. And what's been happening since the global financial crisis, as you can see, the bottom lower level to the right of the chart is the dollar bottomed around the time of the global financial crisis, but has been on a steady strengthening trend for the last 10, 12 years for very good reason. We were the first economy to come out of the global financial crisis. We delevered in a lot of ways. Households were particularly effective in delevering. We dealt with our mortgage crisis effectively. We did not take the Japan route of keeping a lot of zombie companies afloat. And so the dollar has been on a tear, and assets have flown into all dollar related, whether it's our equity market, whether it's our real estate market, bond market, et cetera. The dollar has strengthened because the rest of the world has wanted to own US dollar denominated goods. But that is peaking, and we already started to see some weakness. And in our opinion, with the massive fiscal stimulus going to fight COVID, with the massive current account deficit the US suffers, there are a lot of reasons to think that the dollar has peaked and should actually go into a phase of 5 to 7 years of decline, not collapse. And it's not like the renminbi is going to replace it as a store, and we could talk about that for a long time, but mainly because these trends are pretty hard to dispute. They tend to last 5, 7, 9 years or so, and then the reverse happens. So we do feel that there's a lot of negative pressure on the dollar, and that will be good for emerging market equities because there's an inverse relationship between the dollar and the performance of equities historically. The other big catalyst to conclude my formal comments is the next slide. And this is important for you as US-based investors to think about. The big reason equities do well in emerging markets is when the economic growth differential between emerging markets and the United States improves in favor of emerging markets. So not that the absolute level of growth is different, because it's almost always higher in emerging markets. It's when the rate of change improves for the better for emerging markets. So if you look at that nice big run, and hopefully some of you were invested in emerging markets during that extraordinary bull market from 2000, whoops, did you, just making sure you can still hear me? Yeah, all good?
Yep, it's all good.
Okay, great. From 2002 to about 2010, we had one of the best emerging market runs ever. There was a period where you were getting double-digit returns year after year after year. If you were in emerging markets, it was great. But that was in large part driven, a number of factors driving it, but it was because that growth differential between emerging markets and the US was improving. So that was a period where China was growing 12, 13, 14%. India was growing 10, 11, 12% as well. And then other countries that were providing all the raw commodities to China's massive industrialization and manufacturing base and infrastructure build out. And everybody who's been to China knows they have top-notch infrastructure. Joe and I are here in New York, and I always feel like when you come back from a trip to Asia and you land at JFK and then take a taxi into the city, you just think, wow, which is the emerging country and which is the developed country? Lord only knows we need infrastructure improvement in the US. So long-winded point is that when China was industrializing and improving its manufacturing base and building infrastructure, et cetera, emerging markets had a rip-roaring tear that lasted about a decade. Growth was accelerating, but that all peaked around 2010. And then emerging market growth differential actually declined relative to the US. And the US and all emerging markets kind of swapped places the last 10 years, where emerging markets were going into deep, deep recession after China's industrialization and infrastructure spending peaked and went into decline. You saw that the commodities-oriented economies, whether it was Brazil, Russia, South Africa, they all went into deep, deep recessions because the demand for their exported commodities were in bad shape. But here we are, beginning of 2021 and looking forward. And when we look at objectively growth projections for emerging markets relative to the US, we feel strongly that emerging markets are really going to have the improving growth differential that's going to favor equities in the next few years. Now, we'll talk more about China's growth and where it's challenged. And China has obviously come to dominate emerging markets from a return perspective. But I would just have you keep in mind, and Joe and I will talk more about this, but there is a big demographic overhang in China, which is not the case in places like Indonesia or Brazil, where there's plenty of young people in the workforce. China has more retirees than new people coming into the workforce, and that's going to be an overhang. It has more debt than other countries, and we'll talk about that. So not everything is perfect in China. There are a lot of good companies to invest in. But I think this thing we've seen the last 3 years, where China has driven almost all the returns along with Korea and Taiwan, I think is starting to break up a little. And you saw this the last 6 months, where other countries, Brazil, Russia, Indonesia, India, they were actually beating the overall EM benchmark, and for good reasons. There's reform taking place. There's a commodities tailwind taking place with the world going into post-COVID recovery. And I think there are reasons to be optimistic about other parts of EM as well.
James, thank you. Thank you very much for that presentation. That was great. That was great. Really appreciate it. So let's focus on the 4Ds, which you brought up right in the beginning of your presentation, and we'll go in the order you had. And what I really want to do is think about it in context of the US, China, and emerging markets. So maybe we could touch a little bit on each. And, the first one, which you kind of ended a little bit with, is demographics, right? We started with it and we ended it with it. And, China's that example where it seems particularly bad going forward. We actually put in our explorations, we showed 2055, based on projections of what that looks like. And it doesn't look pretty when you look at a demographic pyramid. As you mentioned, there's a lot more retirees. There's a lot less people in the workforce that have to support those retirees. So kind of curious of your thoughts of how that affects continued growth, what potential creaks there may be in that system. It is I don't even know what to call it, a socialist democracy, a socialist autocracy, So if you could speak to that'd be pretty interesting.
Sure. And again, as we all know, the demographic overhang is just your working age population relative to your retirees. And frankly, China's looks kind of like Belgium's or Italy's. It's not great. One of the reasons that the US is better than China, actually, from that perspective, is because of our immigration policy. And this is one of the reasons that, debates about immigration are not just political, they're actually directly economic. If we're not having babies entering the workforce in the US, we've got to get that input from immigration. Now, China doesn't historically have immigration. It's generally had just a lot of babies being born. But as we know, there's negative consequences of the one-child policy, and that's catching up now. That is starting to loosen. That's been several years now, as everybody knows, that the one-child policy has started to loosen. But that doesn't change overnight. What's interesting is I think there were a lot of pundits and analysts thinking that, oh, wow, China does away with one-child policy, boom, you're going to have a baby boom. No, it's because, as everyone in the United States knows, it's expensive to raise a baby, and it's expensive to pay for housing is expensive in China. Education is expensive. And people actually, when they were given increased freedom to have babies, actually were holding back for economic reasons. So that's an overhang. That's one of the constraints on growth. And that's one of the things my colleague Ruchir writes about in The Rise and Fall of Nations. We consider quite an important factor in why a country has growth or doesn't have growth. So that's an impediment. But something that may actually help China through this is technology, robots. And robots may be arriving just in time to help with that demographic overhang. And if any of you have traveled in China, you've seen that there's a great deal more, I think, robotization of their overall society and comfort with, technological help in whatever form it comes. So, whether it's on the factory floor or whether it's in the healthcare area or whether it's, home health aides, et cetera, I think you might actually see robotization helping fill in that gap. So they may find a way to get over that negative overhang on growth in China. But this is where I have to say that other countries, Indonesia, Brazil, India, plenty of working age population relative to retirees, which gives them an advantage, frankly. And is one of the reasons I think over the next, again, 3 to 5 years, as Joe said, this is, we're not talking about next month or next quarter, we're talking about the next several years. Countries like Brazil, India, Indonesia have some advantages on growth in that regard.
Yeah, thanks. So from an immigration standpoint, right, and I think it is really, that's where America's really been able to shine, right? And we're a melting pot country. We've taken lots of people in from lots of places. We have, and I'd like to touch on education at some point, but currently we have, by far, my understanding, the best college, late education system in the world, which attracts people from everywhere. And so expectations, at least for America, is that immigration should continue. And considering the way our country's set up, you think if we actually did have or start to have some demographic problems, we could probably fix it relatively quickly. I'm curious on the side of China, whether that's a possibility. I imagine there should be some attraction to China from their GDP is growing, it's a growing nation, but I wonder whether they're really set up there, in a lot of contexts, right? It's I think out of the 1.3 billion people, there 900 million are really, very, very, they're from the same group. And I'm just kind of curious of, briefly what your thoughts may be from a political standpoint, from any standpoint. Are they able to overcome, and I want to get to the robotics thing, but are they able to overcome their issues through immigration, or do you think that would be maybe a little less feasible given their population, given the way they kind of run politically there.
Well, as you touched on earlier, and call it what you will, autocracy, or it is a capitalist system. In many ways, it's more brutally capitalist than the United States is. The winners take all in lots of ways in regards. And even though income per capita is going up in China, as everybody knows, 20 years ago, income per capita in China was maybe $2,000 a year. Today, it's closer to 15 or 12 or 13,000. It's rapidly improving. So overall, they're becoming a richer country on a per capita basis. However, as you point out, there are 1.3 billion people, but a lot of people are still in poverty in China. And remember, some of the restrictions on being able to work in Hong Kong were partly because China controls internal immigration strongly. Like there's an enormously controlled system of where you can work and in what cities you can work in that China does control pretty comprehensively. Now it has technology helping control that kind of immigration in general. And anyone who's traveled between Shenzhen and Hong Kong knows there's a massive border crossing where you have to go through multiple, gates and show all sorts of documentation. And it's even more severe if you're a mainland Chinese trying to go to Hong Kong, other than a shopping trip. So I don't think that China is going to open itself up to immigration the way the US historically has, or the way Europe has historically. This is why migration and immigration issues are really relevant. They're not, and why de-globalization is a dark trend in terms of inhibiting growth, because if you don't have workforce population coming in, you're going to have stagnation. And so if I had to compare China and US in very broad terms, I would actually say the US has an advantage over China in that regard.
Yeah, I'd agree with you. It seems like we have a dramatic advantage, actually, given where the demographics are naturally, and given where we're going, and given just how the countries are set up. I fully agree with that sentiment. The other element you touched on was robotics, and I think that's a really, you could throw it in with AI and technology and the whole like, and there's kind of two directions I want to go with that. The first one is, you think that all these technologies and robotics, AI, etc., would positively affect productivity. Yet we have declining productivity. We may circle around and talk about declining productivity generally, but in that context, could you speak about why there's a mismatch there, or perhaps we're just missing it because there's so many other things that may be dampening productivity?
Yeah, I think it's multifaceted, which is why it's so complicated. So there's no one easy, and people have written countless books on it, and academics debate it all the time. But part of it is that when innovation occurs, and everybody knows their Schumpeter from their economic study, there's a new wave of a burst of productivity that comes with a new innovation. And a lot of our tech has been around for a while. So it's not necessarily leading to new gains. And also, people may not be using this new technology in productive ways. They may be spending more time gaming than they are thinking of ways to improve their company's output. What's interesting about emerging markets is, because a lot of the most poor countries, and I include the frontier countries in this category, places like Kenya, Bangladesh, Pakistan, because they didn't have our brick and mortar history that we have as Americans, where we all grew up with a formal grocery store that we shopped in. We deposited our checks in the bank on the corner. But in a lot of these countries, they didn't have those things. They had open markets. They had, in terms of supermarkets, they didn't have supermarkets. They had, farmers selling stuff on the street. They didn't have banks. Most people didn't have bank accounts in a lot of emerging markets. In the more developed emerging markets like Mexico, Brazil, now China, yeah, people have bank accounts. But in some of these less developed ones, they've quickly adapted to technological changes like the use of the smartphone for things like payment system and paying one another. So I know I'm sort of diverting a little bit, but broadly speaking, some of the adaptation of technology has taken place more rapidly in the less developed countries, which is very interesting. So the advent of the smartphone has meant all sorts of productivity improvements in places like Kenya, Bangladesh, et cetera. But I would say that one of the big problems with the coincidence of declining productivity and technology in the developed world is that it's coincided with low interest rates, and low interest rates can't be ignored. And in Europe, they're negative, as we all know. And that has meant that there are more government bailouts. There are fewer defaults. So we're not going through the Schumpeter innovation of letting companies fail as much, because this productivity gain has come, or rather the technological changes have come along with low interest rates. So multiple reasons, we could spend hours talking about it, but broadly, when we just look at how one measures productivity growth, it's actually been on the decline for well over a decade now.
Yep. No, thanks for that, James. And I did want to focus on robotics a little bit. You mentioned low interest rates, and we happen to have a question come in from the crowd, which is, what about rising interest rates? Is there a real threat of the Fed no longer keeping interest rates low? I'll edit myself on this, or the Fed not having the ability to keep interest rates low, right? And maybe we could discuss that, right? Because it's, my gut is the Fed will keep interest rates at zero forever if they could, but some of this isn't in their control. And what happens if interest rates rise? So I think that's a real interesting question. I'll add on one thought and let you go to town on it, James, which is, it feels like you mentioned earlier, emerging markets are not awash in debt, but it feels like all developed markets are actually full of debt, right? The EU, China, us, Japan. So it's interesting. So again, I just want to make sure we do focus, at least, in the beginning, on the question that came in from the crowd about rising interest rates. And
sure,
yeah, go for it.
And one of the things after the global financial crisis, our team spent a lot of time looking at when debt becomes a problem. And I think sometimes in our study of macroeconomics, we have this easy ratio in our head of total debt to GDP and total government debt to GDP. And that's often mentioned or cited, and pundits will throw that number around. We, though, as we all know from our experience here living in the US after the global financial crisis, the government always comes in to bail out problems that occur in the private sector. So if you're looking for a forward indication of when debt's going to be problematic, it's better to look at private sector credit growth rather than total government debt, because total government debt is a static figure, right? That's telling you that the problem's already happened, and now the government's coming in to bail everybody out. So we developed a ratio of looking at private sector growth over a 5-year period relative to GDP growth. And what we found is when that ratio is actually 40% or greater, it actually slows your economy down significantly. So one of the reasons China has slowed down from its peak of 12%, 10, 12 years ago, is because of the massive accumulation of debt within the system. And a lot of it's going to real estate debt and household debt, et cetera, corporate debt, in the state-owned sector, that is. So it is important to look at this distinction when you're looking at countries. And there are a lot of countries that have, because they were in such deep recession, Russia, Brazil, South Africa, they've actually not had the growth of debt that we've had in the developed country, as you point out. And so they go into this cycle now with lower private sector growth, meaning they're at the beginning stages of a credit cycle, which is a good thing. As we all know, some credit and access to credit is a very good thing. It's bad when you have too much credit. So in terms of the US, I would say that part of the reason that the US had the better performing currency over the last 10 years was also because we did have an interest rate differential that favored us over the euro.
Yeah, carry trade. Yep.
Yeah, and but that's diminished with low rates. And at some point, yes, we're not talking about hyperinflation in the US. We're not talking about 19 late 1970s style inflation. No one's projecting that. But there are elements of inflation pressures sitting in the system that could come back that the Fed, as you point out, will just have to respond to. Of course, the Fed doesn't want to raise rates. And you just heard Janet Yellen in her testimony earlier this week saying, you know, this is the time to spend on fiscal stimulus, et cetera, and infrastructure. And I would say that for sure, I mean, this is not speculation. The Biden administration does have ambitious plans to spend and improve infrastructure. And so we probably will see some inflation pressure coming from the fact that the world's biggest, borrower is getting more indebted than ever. So part of it might be beyond the Fed's control. They're just going to have to respond with higher rates. But so the point is that at some point, though, even that interest rate differential aside, currency markets do look at your fiscal deficit and they do look at current account deficit. And the current account deficit in the U.S., despite trade tariff with China, has worsened. And that is one of the elements that will contribute, along with our bloating debt, to, in our opinion, a weakening dollar over the last few years, which is good for emerging currencies.
Yeah, so hold that thought. I want to go back to that last item you mentioned about the trade deficit around de-globalization, because there's some interesting, I think, things going on there. We do have another question from the crowd that I think, so the question is on the real estate bubble in China, or and how that affects them or will affect them. And I think there's been talk of a real estate bubble in China for a long time. In your prepared remarks, you spoke about new China versus old China, and you mentioned in old China, you put real estate in old China as opposed to new China. And then you also spoke a little bit about zombie companies and the fact that one of the reasons we did so well coming out of 2008, 2009, the Great Recession, is that we basically crashed and burned a lot of items and just kind of moved on, right? And that's an important element. So I'm going to take that question from the crowd and add to it a little bit in thoughts of, okay, in China, you have this old economy that they're really holding on to, a little bit Japanese style in a lot of ways, and real estate may fall in that. And so, I'm answering in some ways like they could kind of maybe keep that going for a really long time. Do you have an opinion? Do you see, A, do you see that bubble there? And B, do you see that just being artificially held on to for, I don't know, 10, 20, as long as necessary until it kind of cleans itself out or there's a bad, event?
Yeah, and the questioner is right to say that it seems like it's been a topic for years now. But remember that there are times when it actually becomes a problem for the equity market, as it did in 2015. If some of you may remember that first half of 2015, we're now going on 6 years ago, it was hard to find a China bear. Almost everybody was bullish. Every piece of research about China was bullish. It was just, the market was rip roaring. But part of what caused the market, but it experienced quite a sharp correction in the second half of the year, not just overall China, but the China A share domestic market, which does have a heavier estate component in it. And so I think we should be mindful that China doesn't always just go up. It's had some rough corrections in the past, which can be pretty severe. And part of what caused that or contributed to that correction in the second half of 2015 was a real estate bubble, which arguably was more of a bubble at that time. And part of the way the Chinese authorities pricked that bubble was by raising rates and actually saying that there's too much speculation in real estate. So the Chinese authorities often get too much credit and maybe not enough blame. And there's a perception that somehow they're perfect at fixing their economy at all times. But maybe real estate is one of the areas where they don't have total control when it becomes too problematic. And as I think most people on the call know, ownership of property is a huge part of Chinese culture. You buy an apartment, you're not considered an eligible person for marriage until you own an apartment. So parents often will help a child, by child I mean an adult child in their 20s, buy that first apartment. And then what has happened in kind of booms and boomlets and smaller boomlets is that people realize, oh, they're overexposed to that second or third piece of property that they bought on speculation. So I would just say that that's still out there as something that needs to be monitored, and it's not entirely resolved.
Yeah, fair enough. And I'll just grab on something you said a little earlier in that answer, which is, you know, everybody looks at China and they could do no wrong. Well, one of the reasons you look at China with they could do no wrong is that they are an authoritarian regime. So they control the media and they could say whatever they want, and that's the information you have. And obviously there's people on the ground and you can get other, you know, alternative answers out there, but it is kind of nice, you know, for them when you have that. I think it does, it pushes down on all those stories getting out there, and it pushes down on some of the muck that, you know, or the conversations, I think, relative to America, at least, where or at least relative to, I'll say, the Western world, where everything's really out there. So, you know, there is some marketing element to it that they have a bit more control of, right? And so I think, at least.
And to build on that point, I think it's very interesting that, as you know, with the advent of technology and you know, chat and online payments and social media in every way, shape, and form, the Chinese in general have been fine with the idea of knowing that they're monitored by the government. They find it so convenient to use these various tools that they just say, well, it's just part of the deal, right? We know we're being watched, we know we're being surveyed. We also know that our movements are being tracked. It's partly how the authorities control internal migration within the country and prevent everybody from moving to Hong Kong or Shanghai, which they don't want to have happen. And that's interesting, I think, when you consider back to the main thesis of, you know, the U.S. and China and is our empire crumbling. We still have this concept that privacy matters in the U.S. as a concept. And even when we've had, frankly, terrorist issues in the past, we've still had resistance to letting the government probe our smartphones, right? I mean, it's an issue that comes up in the courts, and you know, we tend to resolve things rather in legal terms in the court system, which again is one of the strengths of the U.S. economy. We still care about that.
That's
stuff.
Right. It's a slippery slope conversation, which we could devote a whole hour to, right? Like,
right.
And it's way away from economics and finance and the whole bit.
Yeah. But it's related, right? It's related to our
totally
technology innovation. And I'd even tie it into part of what happened in China in the fourth quarter, which is the authorities, basically China created its tech giants through protectionism and nurturing and helping build the moat that enabled them to thrive. But it has been resistant to letting foreign tech come into China, right? So part of how they've been able to thrive so much is the government did intervene to protect. So it is directly related to what we all do as investors. But that was very interesting what happened. And there are times when the authorities say, hey, kids are gaming too much in China in 2018, and they actually actively intervene in that regard. There are probably parents in the U.S. who wouldn't mind if we had that kind of intervention.
Yeah,
you know,
give me that. Right, give me that technology for my own kids, and that'd be great.
Right.
But don't do it from the government. Just give it to me.
Right. Right.
That's exactly right. We got only a few minutes left, and I guess the one big topic I want to, or one big item I want to touch on really briefly is new Cold War. Right. We've spoken about it here at Fountainhead quite a bit, about the idea that this is, you know, everybody in America, or I'll say it's a bipartisan, and there's unfortunately not too many things we agree on, but it seems like everybody agrees, Democrats and Republicans, that China is now, I'll put it in quotes, an enemy, right? And you have the breaking up of this world, and we think it's going to continue, where maybe there's two systems, right? There's two technology systems, and countries have to start picking. So do you see it that way? Do you see it as a new Cold War? You know, do you see Taiwan as potentially an interesting area of the world, given their expertise in semiconductors, coupled with the fact that they're right off the shore of China, and China probably thinks that they control Taiwan, and we may want to control Taiwan to, you know, in the way we control things. So maybe we kind of end on that. thought, because that's kind of, I think, it's a big topic of what happens. And if you want, you could even go a little bit further down the road on emerging markets, haves, have-nots in context of that. But curious to your thoughts there.
Sure. And it's a huge, complicated, multifaceted topic, right? All countries, as we know, act in their own self-interest. I mean, that's the basic premise of being a country. China has done that very successfully for several decades. And we all know why the West, the US and European companies were interested in being in China. It's because of their massive domestic market, and everybody wanted to sell whatever product you had in China. And so you gave up intellectual property rights, you gave training. This was part of how every company that wanted to operate in China participated and played in their very tough rules. We know that China joined the WTO, and the thinking in the West was, well, if China's in the WTO, better to have them at the table, and we can control them better that way. But China has just done extremely well. It's grown like crazy from an economic growth perspective. As I mentioned before, its income per capita. And I have to say, give India, 10, 12 years ago, people used to compare China and India and say, oh, the two big giant countries that are both going to have great success. Well, India struggled. India's income per capita is still struggling around 2000. So they cannot be compared from that perspective. China broke out and did increase its wealth per capita. India is still struggling with massive poverty and is a poor country by any measure. And so the Cold War, I would argue, is partly China is a rising country in every way, shape, and form. It's becoming wealthier. It is becoming more important for research and development as well. And this is why it does tie into our immigration issues, because if we put curbs on graduate students coming to the US from China and India, that will arguably weaken our growth and output. And part of what, we don't have the charts here today, and I'd urge people to read more about it, but research and development is increasing in China. And it's because they're protecting themselves better in that regard and realizing some of their students are not able to travel and work everywhere in the world. They also spend, you touched on education earlier, they spend more on and if anyone's been in these stocks, they've seen the nice returns, these online tutorials that supplement the schools that kids go to. So they come home from school, and then in their apartments, they're studying more through these online education programs. So there's a huge commitment to education in China that is robust, and you can invest in private companies to do it, but there's definitely a government, backing for it. So, again, countless books have been written on this, but China probably doesn't want to have a shooting war with the United States. It's not going to be like,
that's right.
It's not going to be like, quite like, and of course, we never had a shooting war with the Russians either, but we had these proxy wars everywhere, whether it was Vietnam or Latin America or Central America, as we all know from our history. China's,
we came close.
Yeah, exactly. And China is doing it through the One Belt, One Road system, where it is kind of getting countries to, it'll pay for development projects. It's sort of, it is kind of Cold War policy in a sense that they want people on their side. But keep in mind, there's also been some backlash in some developing countries, like in Africa, where they see the Chinese presence, they see factories being built or ports being built, but they don't see the economic benefit because their own workers aren't actually there. In some cases, Chinese workers are flown in to do the work, or they'll live in their own little compound and do the work. And so local governments are starting to kind of resist in some ways this idea that One Belt, One Road will benefit them economically. So I think it's a complicated relationship. There's no question that China's acting in its own self-interest. Friend of mine who was at the Financial Times for many years wrote a book. He was the China bureau chief in Beijing for many years, arguing that, in a way, the US enabled China's rise because we paid for the free movement of shipping, right? With our massive Navy presence around the world. And so, boy, did we ever make it easy for China to ship things everywhere in the world. We were the policemen of the seas. And that's something that we may revisit. And arguably, Trump administration.
I think we're already doing it. Yeah,
Yeah.
that's
Yeah.
right. We're really moving away from that. There's no question about it.
Yeah.
Okay, so James, I really appreciate the time. I'm going to have a closing remark and just kind of point out, our thoughts on China versus the U.S. But I do want to give you, maybe 1 minute, if you don't mind keeping it brief, just a little bit about exactly what you do at Morgan and the fund you run there, if you'd like.
Sure. We as a team, we've been investing in emerging markets for 30 years. In fact, Asia was the first place we started investing in 1989. So we have a long track record. We launched a China A-share fund back in 2006. We've been physically present in India for 30 years. And one of our strategies that your listeners may want to think about is our emerging leaders strategy, which is a concentrated approach to this, where we express our high conviction with about 30 stocks in the portfolio. And we're also, that strategy is not in every single country. It's only in about 5-6 countries in EM, including China and India and Brazil and Indonesia, basically the market, and Taiwan, the markets where we feel there's a large enough ramp for growth that a company can actually, grow pretty significantly. And that just goes for high quality growth, steady compounders. We're looking for 15% growers. And we take a 3 to 5 year view with the themes we invest in. So that's something you may want to think about, but we have a wide range of emerging dedicated. And I know some of your clients are in our colleagues in Counterpoint, which is another boutique within Morgan Stanley Investment Management. We are separate. We know them, obviously they're colleagues, but they're on a different team from us. So we are dedicated emerging markets investors, and our emerging leader strategies had extraordinary returns as people can look up.
Well, thank you, James. Thanks for that. And thank you very much. This has been a great conversation. I think we could probably go for another couple of hours if we had the time. So I really appreciate you jumping on for us and our constituents. I'm going to throw up one last slide here just to, have some end remarks here on the U.S. versus China. I wanted to zoom out here to give a longer historical context. If you don't mind, Talia, just there we go. Okay, perfect. So what we did here in the beginning, we really kind of focused on 1700s forward. Here, we're going all the way back to 500. And as you can see, China's always there, right? They've always been relevant. And the question is why? And at least our belief is, well, they always needed tremendous human capital to tame their geography, right? Their rivers are not great. They overflow, they flood things. They've needed, I think I've seen a number in medieval times, they needed 100 workers to work an acre of land as compared to in Europe where you had one person and an animal. So they've always needed tremendous human capital. On the other side, they've had amazing innovations but didn't follow through. They created the printing press, but they created no books. And the reason they didn't create no books is the same reason, there are some of the same governmental issues that you're struggling with today, which is it was authoritarian. It was very centralized. You need centralized government to be able to build the Great Wall of China, to tame the rivers, et cetera, et cetera. And the question is, and James alluded to it, like with Jack Ma, like what's going on there, right? It may just be a slap down. Maybe it's a little bit more. On the other side, so the expectation is, as we see from 500 to today, expectations are for them always to be a world player. We expect them to remain on the world stage. But from the U.S. standpoint, we should also really remain on the world stage. We show it from a Western viewpoint, starting at 1700. We didn't really know much about it prior to I guess the late 1400s. But the strength of our resources, the strength of our approach, the strength of the way we run government, the strength of the location we are in the world, should really, and the strength of our consumer, right? We spend a lot. And so we didn't really get to regionalization, but just, we have a nice virtual cycle here in America, should always keep us relevant and should always keep us near the top of that great empire. And then last comment is, we always go through as a nation, our ups and downs, right? We have the Civil War, we had the Great Depression, and we've come out stronger from it all. So the positive note to end with is, we have come out stronger from it all in the past. We're always going to have some crumbling elements there, and hopefully we could overcome. And with that, thank you again, James, for coming and joining us today. On the screen there, you have my my info and James' info if you want to reach out, if you want to find out more about James, the fund he runs there. You're always welcome to call me and ask any question here at Fountainhead, and appreciate all the listeners and everybody popping in. Have a great day.
Thank you.